My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people, my friends, just trying to make a little money. My job, not just to entertain, but to educate, teach. So call me 1-800-743-CNBC or tweet me at Jim Cramer. When I first heard the idea that at some points in the business cycle, bad news is actually good news, as in bad news for the economy is good news for the stock market, I thought it was ridiculous. I mean, come on. How could something that's good for so many people hurt stocks or vice versa? Yet it's true. Good news can send us down. Like today, where the Dow lost 195 points, S&P shed 0.09%, Nasdaq actually inched up 0.13%. How is this possible? Because the Federal Reserve needs to manage the economy. When they see it overheating, the good news, causing inflation, they butcher us with rate hikes. When they see things have gotten worse, the butchery shops they turn into, they become delicious bakeries. Stocks can rise again. When the bad news comes, it's time to buy. But what exactly does the Fed consider good or bad? That's the big mystery. How do they decide when and where to bring the pain?
The house of pain.
Honestly, it's more complex than most of the professionals will ever admit on air, which is why we need to explain it to you so you can make the best decisions about your own money and your own portfolio. Let's start with what's good for the real world and bad for the Fed. First, our central bank doesn't want to see prices of goods rise more than a couple of percent. Why? Well, pretty simple. Regular people can't make ends meet if these prices are going up faster than their wages, right? There are a whole bunch of numbers the government puts out that measure personal consumption expenditures, consumer price inflation, wages, overall employment, like the Labor Department's all-important non-farm payroll report tomorrow. When they see inflation raging, meaning higher costs everywhere, then the Fed has to act. They can't do nothing. But the way they act, they raise interest rates. Now, that's bad for most businesses and their stocks, although some sectors can do just fine while others do get wrecked. Now, about 58% of Americans do have some exposure to the stock market. Sadly, many of them, though, have big speculative positions that have been hammered this year. Witness that Tesla makes up 10% of the average retail investor's portfolio. That's probably a mistake. Well, I mean, it was great when it was going up. Still, while a lot of people have some stock exposure, most of the market's in the hands of the super wealthy, not the wealthy, the super wealthy. So there's no need for the Fed to consider the fate of individual stocks. Sure, money managers care, but that's not a major constituency. Most people who own stocks do so via index funds. As the Fed sees it, the only people who really get hurt when they lower the boom on the market are those who borrow money to buy stock, or those who are rich enough to have huge positions. These are what I call real unsympathetic plaintiffs. Now, there are times when the president has cared about stocks. Trump was maniacal about the market. They know nothing! Viewing the averages as the ultimate arbiter of his job? But Biden, he couldn't care less. And maybe he shouldn't care. I think he sees his main constituency as people who, like him, when he was the self-proclaimed poorest man in the Senate, have almost no stock exposure. At least that's what he told me when I met him on a train years ago. I'm not here to make policy judgments. What matters is that nobody in Washington is making policy to cater to the stock market, to your stocks right now. Hey, a lot of times I think that they want your portfolio lower, so you'll spend less. What the Federal Reserve cares about is the data that shows the level of inflation. Anything that creates higher prices for a regular person, that's a problem. Although the Fed's very powerful, there are many ways in which it is helpless, because they only have one tool at their disposal to fight inflation. It's a blunt instrument. All they can do is raise rates to make everyone poorer, ultimately pushing prices back down when people don't have enough purchasing power because they don't have enough money. But even that's easier said than done. The Fed can create a climate of fear. They're pretty good at that, aren't they? Where companies tighten their belts, stop hiring, and cut back on their investments. Other companies stop buying the wares of companies. We're going to talk about one of those tonight. That's where we are now, and it's rough for pretty much everyone except big pharma, consumer staples with pricing power, and the banks. Not because they don't have bad loans, but because they make so much money taking your savings, paying you a pittance, and investing it in high-yielding treasuries. That's right. This climate of fear will diminish the earnings power of companies that make things and do stuff at a profit. The ones that can hold up are few and far between, but their scarcity value can send their stocks soaring. Look at Five Below, up 26 points today. because there are so few retailers doing much better than expected in this environment. Why not? It's a trade-down play. We're going to speak to the CEO of this marvelous company later in the show. It will crystallize to you what I like about the stock market right now. Of course, the Fed can go beyond merely creating a climate of fear. They can raise short-term interest rates as high as they want. I've seen them as high as 19, 20%, as they want to throw tons of people out of work. That is a way to lower prices. At that point, businesses put their expansion plans on hold and instead start making contraction plans. Now, what's a contraction plan? Well, you know what that is. And that preserves much-needed cash, doesn't cause any growth. We're beginning to see some of this, and I think Jay Powell knows that if he goes too quickly from here, he'll create too much collateral damage. Do the other people in the Fed know this? This ugly situation is bad news for the economy, or people who lose their job, or people who own stocks. But it's good news from the Fed's perspective because it means they're beating inflation. Remember, most of the people in the country don't own stocks. Also, remember, the Fed does not care about your stock portfolio. They would probably like to see it lower. So you need to think about swapping some of that money into bonds as a kind of insurance policy. The market rallied so hard yesterday because there are so many Fed officials who are eager to bring the pain. But we found out they're losing to a Fed chief who thinks he can beat inflation without throwing you and everybody else out of work. Because he's got a heart and a head. Again, none of these people care about your portfolio. They just don't. It's not important to you. Just not important to them. As investors, what we do want, we want the Fed to focus on which prices it can control. Think of what we heard from the CEO of Hormel the other day. He can't control the prices of some of his commodity inputs. Can he really control the price of ham? Neither can the Fed. Does the Fed really want to make people so poor that they can't afford Spam? I don't think so, although there are some regional Fed presidents who I actually think would probably go for that plan if they think it'd help them. More people buy Spam down 5 years. Imagine that they're probably saying, you know what, if we make it so people are thrown out of work now, they'll be able to buy a lot more Spam later. There's a policy. I think the Fed should be doing much more to crush speculation. It's been able to cool the number of ridiculous SPACs and IPOs. No one else would do that, not the SEC, not Wall Street. That's vital. Those deals represented real cash creation for companies that didn't deserve the cash. The Fed should truly try to discourage any crypto investment at this time after the FTX thing. Crypto con. Hey, listen, I'm going there. I'm sorry. I like truth. I'm not paid to tell the truth. I'm paid to think. And my thinking says, you know what? Well, I mean, obviously people want me to tell the truth. But sorry, my thinking sounds like a con. Now, of course, the people who are in that think that everything else is a con. But you know what? I'm calling them cons. It would rein in speculation and save money if the Fed were to come out and say, you know what, crypto? What is that about? The Fed could also have been a lot more vocal about how the government was planning to create too many jobs with the big spending packages we've seen over the year. They didn't say anything. I get why they don't want to involve themselves in partisan politics. I don't want them solving the railroad issue either, and that's where we got a strike averted just now. But at the same time, the Fed needs to state what's beyond its control, just like Jim Snee, CEO of Hormel, did last night. At this point in the business cycle, Jay Powell has to lay out the score by explaining the areas where he thinks he can bring down inflation and the areas where he really can't. Fertilizer up 40% because of Ukraine. If he did that, it would be much easier for you to figure out where to put your money. For better or worse, though, that's not his job, which is why we have to spend so much time reading the Fed tea leaves. I will say this. Right now, they've made it harder to make investing decisions than almost any point in my career, or at least in the last 15 years. And we talk about this every day at the CNBC Investing Club. You should join. You'll see what it's really like. We make these decisions based on all this stuff. You see what it's like so you can do it. The bottom line, unless the super hawkish Fed heads who want to raise short rates to 5 to 7% are silenced, we must be ready with a quarter of 1 foot out the door. You know I love stocks long term, so I'm not going to take more than one. I'm not going to put a full foot out the door. Yesterday, Powell gloriously muzzled the hardliners. To me, that's a green light to stay in stocks, but it is touch and go until we get some indication as to whether he'll be willing to declare victory after he crushes speculation, hoarding, profiteering, and inefficiency without ruining the rest of the economy. Robert in Texas. Robert.
Hello there, Jim, and thank you for taking my call. I was just wondering your take on Kohl's, because they're changing CEOs. Should I sell it or should I hold it or wait until after
we got to find out that
Christmas
CEO, Kingsbury. I like that guy so much. If Kingsbury stays, he's an interim CEO. He's dynamite. I saw what he did at Burlington. Now, going to Kohl's is actually not fun. I don't know. How do you make it fun? I don't know if they could turn Kohl's into Five Below, but they got a lot of stuff that's worth more than $5. Although I think that the prices at Five Below indicate more value. Anyway, unless the super hawkish Fed heads who want to raise short rates to 5 to 7% are at least muzzled, we got to be worried, okay? And yesterday, Powell did muzzle them, and that's why we had such a big rally. To me, that's a green light to stay mostly in stocks. Join the club and find out more. Mad Money tonight. CrowdStrike tumbled after earnings. So could the cybersecurity company that is so good regain its defense against the bears on Wall Street? I'm going to get the latest after the CEO. Then it's time to take a bite of the quick services restaurant stocks. I'm revealing my best of breed. And Five Below offers shoppers a bargain. But after today's big post-earnings jump, are investors able to find a bargain in the stock? I'm breaking down the quarter with the company's top brass, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.